What if your money could buy you a piece of the world, literally? Real estate investing promises wealth, passive income, and stability, but it's not all smooth sailing. Want to know the real pros and cons before jumping in? Let's break it down. What is real estate investing? Real estate investing is about putting your money into properties, homes, apartments, commercial spaces, to generate income or profit. It's tangible, unlike stocks, and can mean buying a rental property, flipping houses, or investing in real estate investment trusts, REITs. It's a path to wealth that's been around forever, but it's not a one-size-fits-all deal. Take Jamal, a 32-year-old IT specialist with $20,000 saved. He's eyeing a rental property to build passive income. Historically, real estate has delivered 8 to 10% annual returns, per the National Association of Realtors, blending appreciation and rent. Jamal likes the idea of owning something concrete, not just numbers on a screen. It's versatile. You can buy physical properties, invest in REITs through a brokerage, or crowdfund via platforms like Fundrise. Each has trade-offs, control versus effort. Jamal starts small, exploring REITs for low entry costs. A 2023 S&P study showed REITs averaged 11.5% returns over 20 years, competitive with stock. Emotionally, it's grounding. Owning property feels like staking a claim. But it's not passive like dividends. Properties demand management. Jamal learns this upfront, weighing time against rewards. Practically, start with your goals: income, growth, or both. Research local markets or REITs via Zillow or Morningstar. It's about matching your resources to the right strategy. Pros: potential for passive income. Rental properties can be a cash machine. A well-chosen property generates steady rent, covering costs and leaving profit. In 2022, U.S. median rents hit $1,900 monthly, per Zillow, potentially $22,800 yearly for a single unit. For example, Sarah, a 38-year-old nurse, buys a $200,000 duplex, putting 20% down. With a 4% mortgage, her monthly payment is about $800. She rents one unit for $1,200, netting $400 monthly after expenses. That's $4,800 yearly, a 12% return on her $40,000 down payment. Beyond cash, properties often appreciate. From 2010 to 2020, U.S. home prices rose 5% annually, per Case-Shiller. Sarah's duplex could be worth $300,000 in a decade, boosting her wealth. Tax perks sweeten the deal: deductions for mortgage interest, depreciation, and repairs. Sarah consults a CPA, saving thousands yearly. Emotionally, it's empowering. Her property pays her bills while growing in value. Practically, Sarah uses BiggerPockets to research markets, targeting areas with rising rent. She learns tenant screening to minimize risks, making income feel reliable. Pros: diversification and stability. Real estate diversifies your portfolio beyond stocks or bonds. It's less tied to market swings. During 2008's crash, while stocks fell 40%, many rental markets held steady due to housing demand. Consider Priya, a 29-year-old teacher investing in a REIT like VNQ, yielding 3.5%. When tech stocks tanked in 2022, her REIT stayed stable, cushioning losses. A 2021 Nareit study showed real estate had a low correlation, 0.3, with equities, reducing portfolio volatility. Properties can hedge inflation. Rents and values rise with prices. In 2023, inflation hit 6%, but rent growth matched or beat it in many cities. Priya's REIT dividends rise, too, preserving purchasing power. For hands-on investors, properties offer control. Priya could buy a small rental, setting rents or upgrading to boost value. This tangibility feels secure, unlike volatile stocks. Practically, diversify across property types: residential, commercial, or REIT. Priya uses platforms like Roofstock for turnkey rentals, balancing effort and stability. Pros: leverage to amplify returns. Leverage, using borrowed money, supercharges real estate returns. A 20% down payment controls a property worth 5 times that, magnifying gains. If a $100,000 home rises 5% to $105,000, your $20,000 investment gains 25%, $5,000. Take Noah, a 26-year-old barista, buying a $150,000 condo with $30,000 down. If it appreciates to $165,000 in a year, his equity jumps from $30,000 to $45,000, a 50% return. Rent covers his mortgage, making it low risk. Banks love real estate loans. Mortgage rates in 2023 averaged 5%, cheaper than other loans. Noah's credit score of 720 secures a low rate, maximizing profit. Emotionally, leverage feels like a superpower, but it's not reckless gambling. Noah studies cash flow. Rent must exceed expenses. He uses calculators from Bankrate to ensure positive returns. Risks exist. Leverage amplifies losses too. Noah avoids overborrowing, targeting properties with strong rental demand via local market data on Zillow. Cons: high upfront costs and illiquidity. Real estate isn't cheap. Down payments, closing costs, and repairs add up. A $200,000 property might need $50,000 upfront, locking out beginners like Mia, a 30-year-old freelancer with $10,000 saved. Even REITs require capital, though less. $500 can start you on Fundrise, but returns take years. Illiquidity is tougher. Selling a property takes months, unlike stocks sold in seconds. In 2022, some markets saw homes sit for 60-plus days, per Redfin. Mia feels the pinch. Her money's tied up, limiting flexibility. If she needs cash, selling means fees or delays. REITs are liquid but can swing like stocks, dropping 20% in 2022's rate hike. Emotionally, this can feel trapping, especially in emergencies. Mia mitigates by starting with REITs, avoiding physical property until she's saved more. She researches low-cost entry points like crowdfunding, easing into real estate. Practically, budget 25% of property value for upfront costs. Use liquidity calculators online to plan. Mia's cautious approach keeps her options open. Cons: management and maintenance hassles. Owning property isn't passive. Tenants, repairs, and regulations demand time. A leaky roof or bad tenant can cost thousands. In 2021, landlords spent 8% of rental income on maintenance, per roof stock. For example, Liam, a 33-year-old engineer, buys a rental. A tenant skips rent, and eviction takes 3 months, costing $2,000 in legal fees. He's stressed, juggling repairs and work. Even REITs aren't fully hands-off. You must monitor performance. Liam's REIT dipped in 2022, forcing him to reassess. Emotional toll, frustration from unexpected issues. Mitigate with property managers, but they charge 8 to 10% of rent. Liam uses BiggerPockets forums to learn tenant screening, reducing headache. He considers turnkey properties, where management's handled, but checks costs first. Practically, budget 10% of rent for maintenance. Use apps like Stessa to track expenses. Liam's proactive steps turn hassles into manageable tasks. Cons: market and interest rate risk. Real estate isn't immune to market swings. The 2008 housing crash cut U.S. home values by 20 to 30% per Case-Shiller. Rising interest rates, like 2022's jump to 7%, raise mortgage costs, squeezing cash flow. Sophia, a 40-year-old consultant, buys a rental in 2021. By 2023, rates rise and her adjustable-rate mortgage jumps, cutting profits. If home values dip, she's underwater, owing more than the property's worth. REITs face similar risks. Rate hikes tanked REIT indices 25% in 2022, per Nareit. Sophia feels the uncertainty, questioning her timing. X posts highlight investor fears, amplifying her concern. Mitigate by locking in fixed-rate mortgages or diversifying into REITs with low leverage. Sophia researches markets with stable demand, like Sun Belt cities, using Zillow data. Practically, stress test investments with calculators assuming 2% rate hike. Sophia's caution, focusing on cash flow positive properties, keeps risks in check. Building a real estate strategy. Start with your risk tolerance and capital. Low funds? Try REITs or crowdfunding. More capital? Consider rentals or flip. Diversify across markets or property types to hedge. Elena, a 28-year-old teacher, starts with $5,000 in a REIT like O, Realty Income, yielding 4%. She adds a small rental later, balancing income and growth. A 2023 Nareit study showed mixed portfolios, REITs and physical properties, cut risk by 10%. Research is key. Use Redfin for local price trends, X for investor sentiment. Elena targets areas with job growth, like Austin, for rent stability. She calculates cash-on-cash return, aiming for 8% plus, to ensure profitability. Emotionally, it's about aligning with goals. Elena wants income now, growth later, so she blends REITs for ease and rentals for control. Apps like CoStar track her portfolio, making strategy feel achievable. Monitoring and adjusting your investment. Real estate requires regular check-ins, like a car needing oil changes. For properties, monitor rent trends and maintenance costs quarterly. For REITs, track dividends and market conditions. David, a 31-year-old freelancer, owns a rental and a REIT. He checks Zillow for local rent shifts, up 5% in 2023, so he raises rent. His REIT's yield drops, prompting a switch to a stronger performer. A 2022 Morningstar study showed active management boosted real estate returns by 1 to 2%. Adjust for life changes or market shift. David refinances when rates drop, saving $200 monthly. He follows X for real-time market vibes, avoiding knee-jerk moves. Use tools like Stessa for cash flow tracking or REIT apps for performance. David's routine, quarterly reviews, data-driven tweaks, keeps his investments humming. Real estate investing offers passive income, diversification, and leverage, but it comes with high costs, management hassles, and market risk. We've explored how to weigh these pros and cons, from rentals to REITs, and build a strategy that fits your life. Start small. Research one property or REIT today, and take the first step toward building wealth with real estate. Action turns dreams into reality. Check the description or pinned comment for free resources and exclusive real estate tips to kickstart your journey. Since you've stuck around, YouTube's picked the perfect next video for you. It's on screen now, so keep exploring,